Welcome to today's Explainer, breaking down Meta's Q1 2026 earnings performance. If you're an institutional stakeholder, this is absolutely one of the most consequential tech briefings you're going to see all year. We're not just looking at basic social media metrics today. We are looking right under the hood of a company trying to architect the entire future of global AI infrastructure. This quarter, it's a massive pivot point. It's literally the moment where the incredible cash generation engine of digital advertising meets the astronomical capital requirements of the artificial intelligence arms race. So, we're going to dive deep into exactly how Meta is executing on its strategic objectives, how they're managing these colossal capital allocations and navigating a really complex macro environment to fund a vision that could, quite frankly, redefine human-computer interaction. Let's get into it.
But real quick, before we get to the data, please note that this video is for educational purposes and not financial advice.
Okay, here's our roadmap for today. We've got 1. Q1 2026 executive highlights. 2. Revenue by user geography. 3. Foreign exchange impact. 4. Segment financial performance. And 5. Future guidance and CapEx. We'll be focusing closely on macro trends, segment execution, and those major AI investments shaping Meta's future.
Starting off with Section 1, Q1 2026 executive highlights. Let's look at the top-line revenue beats and the strategic milestones that set the baseline for the quarter.
The tone from the top here is absolutely critical. CEO Mark Zuckerberg really emphasized their rapid progress, saying, "We had a milestone quarter with strong momentum across our apps and the release of our first model from Meta Superintelligence Labs. We're on track to deliver personal superintelligence to billions of people." Now, you guys, this isn't just about feeding us a better content algorithm anymore. This is a monumental pivot in corporate identity. Personal superintelligence? That means moving from merely connecting people to connecting people with personalized, ubiquitous AI agents that actually manage their digital lives. It's an always-on digital proxy for consumers, and for the enterprise, it signals automated workflows powered by proprietary models integrated directly into the platforms where billions of users already spend their time. It's a very clear signal to stakeholders that Meta sees itself as the primary architect of consumer-facing AI.
And wow, that incredibly ambitious vision is being funded by some truly extraordinary financial execution. Look at this. Q1 2026 total revenue came in at a massive $56.31 billion. For an enterprise of this size and maturity, hitting a 33% year-over-year growth rate is just stellar. I mean, to put that into perspective, back in Q1 of 2025, they were sitting at $42.3 billion. They literally added a staggering $14 billion to the top line in a single year. That is like absorbing the entire annual revenue of a Fortune 500 company in just one quarter. It demonstrates immense pricing power, deep engagement across their user base, and a highly optimized ad delivery network that is just outperforming pretty much every peer in the digital ad sector right now.
Moving on to Section 2, Revenue by User Geography. Let's break down exactly where this $56.3 billion is coming from across the globe.
What's really interesting here is the steady, synchronized climb across all major global regions, both quarter over quarter and year over year. The US, Canada, and Europe are still forming a massive, high-margin foundation for the business, for sure. But when you look at the aggregate growth stacking up globally, we aren't seeing a story of one region carrying the weight while others stagnate. It's a broad-based acceleration that really speaks to the universal monetization power of their whole family of apps ecosystem.
Let's quantify that with some hard numbers, because the regional jumps are honestly incredible. In the US and Canada, revenue jumped from roughly $18.6 billion in Q1 of 2025 to over $24 billion in Q1 of 2026. This tells us ad buyers are clearly willing to pay significant premiums for Meta's targeted inventory in North America. But look at Europe. Europe saw a massive leap, going from $9.6 billion to $12.2 billion. Generating that kind of explosive growth in Europe, amidst some of the most stringent digital regulatory environments and privacy frameworks on the planet, shows an incredible ability to navigate things like the Digital Markets Act while still extracting maximum revenue. Asia-Pacific and the rest of world segments showed robust health too, proving definitively that this 33% global growth was a total synchronized victory.
All right, Section 3, Foreign exchange impact. We've got to discuss how macro factors impacted this reported top-line growth.
As institutional investors know, we always have to separate operational success from currency fluctuations, right? So here, we're contrasting the 33% reported GAAP growth with the 29% constant currency growth. By translating the current period revenue using the prior year's exchange rates, we clearly isolate the foreign exchange impact. And this is exactly what portfolio managers care deeply about, stripping away that macro noise to see the true underlying demand for the company's core product.
While 29% is still an incredibly strong operational metric that beats industry benchmarks, it is definitely vital to acknowledge that global currency markets were working in Meta's favor this quarter.
So the crucial takeaway here is that favorable foreign exchange rates gave Meta roughly a $1.74 billion tailwind to the quarter's revenue. Think about that for a second. That $1.74 billion macro benefit is larger than the entire quarterly revenue of many mid-cap technology companies, and it was generated entirely by favorable exchange rates. It's a fantastic bonus for the quarter, but stakeholders must model future quarters knowing that this exact tailwind could easily turn into a headwind if the US dollar strengthened significantly against the euro or other key currencies.
Section 4. Segment Financial Performance. Let's dive into the stark contrast between Meta's core business and its future technology investments.
Okay, here is the great balancing act at the very heart of Meta. We've got a massive $26.9 billion operating income from the family of apps, directly funding a $4.02 billion operating loss in Reality Labs. The core apps, Facebook, Instagram, WhatsApp, they are essentially functioning as an unprecedented, highly efficient cash-generating engine for what is basically an internal venture capital mega fund. Reality Labs is consuming $4 billion a quarter to build out the virtual reality hardware, operating systems, and augmented reality glasses that management truly believes will define the next decade of spatial computing.
And despite the heavy capital allocation and all the massive headlines directed toward Reality Labs, the reality of the current cash flow is pretty stark. The family of apps still accounts for nearly 99% of all revenue generation, pulling in $55.9 billion compared to Reality Labs' $402 million. At the end of the day, Meta is essentially a wildly successful advertising company that happens to be using its profits to incubate a massive consumer hardware and spatial computing division.
Yet, here's what institutional stakeholders should find most impressive. This is a true operational marvel. Even while absorbing that $4 billion operating loss from Reality Labs, the overall business still managed to maintain a highly profitable 41% operating margin. That exactly matches their operating margin from Q1 2025. It really proves that Mark Zuckerberg's highly publicized year of efficiency wasn't just some temporary cost-cutting measure. It created lasting operational discipline. Management is exercising incredible cost control within the core business, allowing them to fully fund these future tech losses without punishing the overall bottom line. Finally, Section 5, Future Guidance and CapEx. Let's turn to management's expectations for future revenue targets and their expanding capital expenditure plans, because the market is always forward-looking. Management's forward-looking guidance paints a picture of incredibly aggressive scaling. They noted strong Q2 revenue targets in the range of $58 to $61 billion, showing extreme confidence in their near-term advertising pipeline. But the real headline, the number that literally requires a double-take, is the 2026 capital expenditures range, increased to $125 to $145 billion for a single year. That is a historic, almost unfathomable level of corporate investment. To put that into perspective, that capital expenditure range surpasses the entire gross domestic product of many sovereign nations. Which leads us to the critical question that is absolutely dominating the minds of every institutional portfolio manager today. What exactly is driving this massive capital outlay? Where is up to $145 billion in cash actually going?
Well, the answer lies directly at the center of the AI arms race. The CapEx increase directly aligns with Meta's strategy to aggressively scale its proprietary AI infrastructure. When management talks about higher component pricing, they are referring to the intense global bottleneck for cutting-edge AI chips, like NVIDIA's newest highly expensive GPU architectures. And buying the chips is only half the battle. They are building gigawatt-class data centers from the ground up. These facilities require entirely new architectural designs to handle massive energy requirements, power distribution networks, and advanced liquid cooling infrastructure necessary to keep these supercomputers from melting down. They are literally pouring concrete and laying fiber optic cables to build the physical computational foundation required to train and run the Meta Superintelligence models we discussed earlier.
So what you should really take away from this explainer is the sheer scale of Meta's delicate balancing act. Can they successfully balance the massive cash generation of their apps with the staggering capital required to build personal superintelligence? If Q1 2026 is any indicator, they certainly have the cash flow, the margins, and the operational discipline to attempt it. But with CapEx potentially reaching $145 billion, the stakes are definitively higher than ever before. Thank you for joining me for this deep dive into Meta's financial architecture. Please remember to like and subscribe for more videos.